Welcome back to the Dividend Diplomats YouTube channel, guys. You got Bert and Lanny, your favorite dividend investors, guys. Today, we're going to have a little fireside chat about three stocks that are on my chopping block. The question is do I chop it off here in 2024? Do I wait till 2025? And then what do I invest the over $10,000 of proceeds into?
Smash that subscribe button, everybody. Give this video a thumbs up. Holler at your boys, the Dividend Diplomats. So it's always fun. We're doing some portfolio cleanup. I did this a few weeks ago. I cut three, invested it into Google, and I saw some nice returns from there. I followed Lanny's suit throughout 2024. This wasn't the first time we've done it. Lanny's exited 10 positions so far this year, Lanny, by chopping them out of your portfolio?
Chippy, choppy, choppy, choppy.
Yeah, so let's see. Are there three more that we can do any can do to help clean up that portfolio? Maybe lock in some tax savings in future years to offset future transactions, but also just making life easier, making it easier to cover and follow your portfolio too.
Yeah. I mean, guys, now that we have all this experience investing, if you're a beginner investor, you're a new investor out there, it's always nice buying stocks because of yield or buying stocks because there are companies in your backyard or buying stocks because, hey, they're cheap right now. But then if you realize that, before you do it, we recommend obviously saying, oh, yeah, is this a large position that I want to continue to hold
Mm-hmm.
possibly forever? We're forever investors on here. We're not traders. We are investors. We invest in companies that we believe will do well. Now, there's been, time periods, especially during, COVID, is one. And, again, being a local Northeast Ohio guy represents another. And then thinking, hey, what could go wrong with a consumer goods stock is another. That kind of rounds out all three. And, realizing, the one is okay actually when we go through the stats, but again, it's more of don't build up so many positions that you stretch yourself too thin and that the portfolio doesn't behave the way it should.
That's right. So that's really the goal of it. We'll talk through. We'll see kind of what the feeling is, why you're even thinking about these in the first place, Lanny, because each one of them are on this list for a reason, as you said, and you kind of hinted at. So there's a reason why you want to get rid of them. So what we're going to is we're just going to talk through it. We're just going to see what it is that's really bothering you about them and just get everybody's thoughts. So as we read these stocks to everybody, if you invest in them, if you have an opinion about them too, please throw it down there in the comment section below. And oh yeah, before we jump into the first one, hit that subscribe button if you've gotten this far and haven't already done so.
Yeah, guys, support. It takes 2 seconds. So, guys, three stocks. These are all long-term holdings, all stocks in my taxable account. So there is some tax benefit to doing this. Again, for long-term investors, if you have long-term capital gains, again, I have to go back through my tax guidance since it's not too often that we sell transactions, but you can deduct up to $3,000 a year for long-term capital losses and then keep rolling it forward until it's, for a period of time.
Yes, and the goal then would be obviously, since we're so close, if you're in a good tax position, Lanny, so far it's here, everything being offset, then you can roll it forward next year, which means you can have this exact same conversation again. Maybe one of these companies that you've acquired, that you've invested in has gotten acquired and there just happens to be a large gain. Or maybe there's just a stock that you want to take some gains off the table and you know that you've banked up these losses to offset it, which helps give you a nice little benefit on the return side too.
Yeah, so that's obviously a decision point here, guys. But we're going to go through the three stocks that I've held for years, some even over a decade. The first stock is really back in the backyard of Akron, Ohio, where I'm from. It's a utility stock. First Energy Corp, ticker symbol is FE. Held this for years.
Mm-hmm.
They've had some years where they have raised the dividend.
Yep.
They've had years where they cut their dividend. They've had years where they've rebounded their dividend. They didn't raise their dividend this year, but they did have a couple years in a row, but they're back to no dividend growth.
Yeah, you're
And,
also the couple of years of massive bribery scandals too with First Energy in there too, because that's also what's kind of spun up in this. You have all the dividend news, you have all the utility news, but they were also bribing Ohio officials to help get nuclear grants, and that whole mess imploded Not to be ironic with nuclear plants imploding, but that's basically what happened with First Energy behind the scenes. And we heard a lot of it because we are in Ohio.
Yep. Yeah, you're spot on. So I own 145 shares. My cost basis, according to my investment platform, is about 5.5 grand. It's worth about 5.9 grand. I've got a little bit over $327 unrealized gain on it. They currently yield about 4%. They provide about $239 in forward income here. So that is the one out of the three stocks that I have a long-term gain on. It's a utility player. Again, I've been writing covered calls sometimes on it over the last 12 to 18 months, which is when, I usually write them with low deltas and, kind of grab a little bit of that option premium income. And usually I do it when it's about 10% higher than the current share price. Cause I'm like, hey, if it gets called away, by all means take it. But then, it's creating my own dividend growth essentially by the option premium.
Yeah, and if you look at First Energy over the last 5 years too, I have their 5 year chart up. Their peak in the last 5 years was February 12th in 2020, right before COVID, when they were above $50 a share. They were at 51.48. Since then, they've been as low as in the high 20s. They peaked again in 2022 at 46. But over the last year, honestly, Lanny, they've really just kind of hovered between 36 and 42. It's been a very flat line. You're absolutely right for First Energy. So it's kind of stuck in neutral right now.
So buy in 36 and sell at 42 and keep doing it. No, I'm kidding. So that's the first stock I'm exiting for various reasons. One, lack of dividend growth. Two, Bert's hit it on the head, lack of overall return, lack of overall growth of the company. And then three, it's just another position that I built up a lot with a $5,000+ investment, built up a lot over the years. But really, it's like, what is my capital doing?
Yeah, what's it doing for you? So that's number one. Number two, we're going out of the utilities. We're moving into the consumer goods, the consumer packaged goods too. This one's actually got a higher yield than First Energy by almost a 1%. Who are we talking to, Annie? Who's number two on the chopping block?
Yeah, so this is Kraft Heinz, KHC. I own about 67 shares, guys. Who else is a Kraft Heinz shareholder? Yeah, there it is. We actually used to own Kraft stock before Warren and 3G Capital merged Kraft with the Heinz ketchup company and formed KHC, Kraft Heinz. And, have about 3.4 grand invested according to Ally. And it's worth only about 2.1 thousand. So I'm sitting at a $1,300 unrealized loss.
Yep.
Produces about $107 in dividends, with a yield of just over 5%.
Yeah, this one just hasn't worked out. Buffett didn't unlock the value of 3G Capital, and it's again like so much. It's kind of stuck in neutral. This one though has at least had some higher swing this year. I think Kraft was up to in the high 30s at one point in 2024. I'm taking a quick look at the chart. In April, it was at 38. In October, it was at 36. And it's obviously jumped down with every other consumer packaged good in the last month as people are worried about RFK and the impact he's going to have on the industry.
Yeah. And again, if you look at the overall 5-year return, it's flat over 5 years, guys.
Yeah.
And they haven't really done anything with their dividend. In fact, didn't they reduce it shortly after the combination because of all the debt?
Yeah. Yes, they did, Lanning. They absolutely did. So, yeah, I mean, it's just not working out. I don't know how to say it. If there's ever going to be a company that split itself up to try and figure it out, this would be the one. But we've also known how our luck with spinoffs. So if you can find one that you like better and just ignore the noise, it's always a great option to see if you can allocate your money elsewhere.
Yeah. And again, Kraft previously was a growing company, growing dividend. And Kraft Heinz just hasn't been the case, guys. So, again, a big $1,300 unrealized loss. Netting that with First Energy, I'm already at a net $1,000 unrealized loss.
Woo!
So that would be at a 22% bracket, 25% overall tax. If you want to throw in some state, you're looking at a couple $100 of tax savings as well to unlock with that.
Yeah. So that's two, everybody. First Energy is number one. Kraft Heinz is number two. Number three, lay it on us.
Yeah. Apologize to you guys if I'm a little stuffy and with a sore throat over here, down here in the bunker. But but we are talking about Paramount Global, guys. PARA, the entertainment company, guys. Skydance, let's go. 192 shares in my portfolio. Woo!
We really missed this our opportunity with Paramount when they were in the meme stock craze when they were at $100 a share. We should have just
Oh my god.
that was years ago. We should have dumped it, but this sector has been famously in some trouble right now as debt's killing the low cost of generating content, and everybody's vision for streaming is just kind of going out the wayside.
Yeah, and they're down 22% this year, pretty much lost all value. I'm down thousands. Cost basis shows 6,000. I was buying a lot of this when it was Viacom, and it was a growing dividend every couple of years, solid yield,
Yeah,
solid entertainment company. And then
it's cheap to
COVID
produce.
happened,
Yeah,
and yeah,
it was cheap to produce the content. That's what every it was. That was so cheap for these companies. You could easily spin stuff up and produce it when you could borrow at 1 or 2%.
yep. So sitting at $3,900 loss, $38 in dividends. They did cut their dividend about a year and a half ago. 1.78% yield, $38 in dividends, guys. So
Paramount.
Paramount, a dog, one of the biggest dogs.
Yeah. So let's take a step back here, Lanny. You've had your three stocks. You've talked about it on an individual basis. Let's summarize the overall. If you were to sell all three, what would be the at the same time? How much cash would you get back? What would be the total loss, and how much dividend income would you give up?
So I'd get back about $10,130 in cash. I'd get about $4,900 in a net unrealized loss position, which would save me, about $1,200 in taxes. I would lose about $384 in dividends at 3.79%.
Okay, so obviously the part of the equation is what are you going to replace it with, right? Like you want to be able to make a move and then put the cash to work right away so that you're not giving up anything. So you have a 3.79% yield for next year that would be offset partially by the tax savings of what you're going to have, but still, what do you have a target yield? Do you want to do yield for yield, or are you willing to take a little yield off to get into a better company with the funds?
Yeah, I'd be willing to take a little bit of that yield off with more performance, more dividend growth. Growth is the key word here, growth overall. Companies growing, dividends are growing. Some names do come to mind. You do have Pepsi, you do have PACCAR. You do have a lot of other industries that I'm not even investing into. And again, this is three different stocks that I own, so it would be nice to at least consolidate that. I do get, again, $1,200 in tax savings if I did that today.
Agree.
And I would be able to capture at least 3,000 of that this year, or majority of the loss. So I'd get majority of the tax savings in 2024. I'm not sure. Again,
Yeah.
I really want to move on, but I hate not having the second play. I know I'm stubborn, or I just don't want to have it sit in cash, and then kind of lose sight. Because to be honest, I think even my Intel, when I had 100 shares called away last year, I think that's just still sitting in cash.
Yeah. I mean, that's the hard part of this decision. What are you going to do with the funds? That is the hardest part of this equation. So, everyone, let us know what you think. If you were Lanny, would you dump the three losers and look for greener pastures on the dividend front side? Would you do it now, or would you wait till next year? Or of the three, is there one of the stocks that you're like, hey, I feel good about this in 2025? I think this sector can actually outperform. Maybe hold on to this one, Lanny. Throw that stuff down in the comment section below.
Yeah. Yeah, is Paramount at such a low point that, oh yeah, you'll rebound 20, 30% in the next 12 months? Is Kraft Heinz at a low as well, and they should see a resurgence? Is there an acquisition ready? Because Mondelez is over here possibly buying Hershey company. So is there something in the works on any of these three? I mean, guys, if you were me, would you go ETF route? Would you go VYM? Would you go SCHD? Would you go Realty Income? Would you go PepsiCo? Let me know in the comments kind of like what you're seeing. If you would do it now, if you do it next year, and if you were to do it, what are you moving into? Let us know.
Oh, yeah. If you haven't already, subscribe to the channel. Give this video a thumbs up. And Lanny, why don't we send these people off here?
You're either with us, guys, or you're against us, Jack. That was Bert the Herd and Lanny from the Dividend Diplomats. Over and out.